Good afternoon, or good morning or evening if you're a long way from Europe, and welcome to this ACT webinar on optimizing the goals of security, liquidity, and yield in today's liquidity landscape. In other words, it's about investing your spare cash. I'm Will Spinney, Associate Director of Education at the ACT, and I'll be chairing this discussion today. We welcome back Lloyds Bank as our sponsor for this topic today. This webinar will last for 45 minutes. I've never had much cash to invest in my time as a treasurer, but I'm sure we'll hear cash is at all-time highs despite low or even negative interest rates. The ACT ran a survey last summer about cash holdings. This is available to see on our website. What it showed was that many firms had plans to spend this spare cash, but equally many expected the balances to increase. The major reason for having this cash seemed to center around either uncertainty about the economy in general or raising finance, or taking advantage of low borrowing rates, arguably perhaps both sides of the same coin. So it's an increasingly important part of a treasurer's skill set. So listen. We have with us today Nick Burge, Managing Director, Head of Strategic Liquidity at Lloyds Bank, to guide us in the right direction. Nick has the floor today, but I will pose some questions as we go along, and you also will have the chance to ask questions. A little bit about the technical aspects of today's webinar. Let me explain this so that you can get the most out of it. You will see a menu bar across the bottom of your screen that allows you to open various windows. You can move these around the screen, resize them, or minimize them as you choose during the webinar. You'll be able to see the slides in one window, and another button will open the Q&A window. So you can send in questions by typing in that particular window. Please don't wait until the end of the presentations to send in your questions. Just send them in as they occur to you. We'll be looking at these questions throughout the webinar. We won't be able to get to them all, but hopefully we'll address the more important issues, and we will never reveal who has asked a question. If you do have any technical difficulties during the webinar, the green button with a question mark is the window to head for. And finally, a recording of this webinar will be available on the ACT website in 2 days, along with a separate copy of all the slides. So, Nick, I think it's over to you.
Will, thank you very much for that. So, my name's Nick Burge. Welcome to everybody. Obviously can't see you here, but I can see the list of attendees, and thank you very much for joining us. So we're going to talk about liquidity. It's a vital topic for companies. It really is one of the key things that companies need to consider. As we know, companies tend to go under because of lack of liquidity. If you don't have the cash, you can't pay your bills, and you then have a solvency event. So liquidity is absolutely the core of business management. Today we're going to run through where is the liquidity landscape, what are the key factors driving the challenges of managing liquidity, what are the key objectives you're trying to meet, how you'll achieve those objectives, what policies you need in place, some thoughts around sizing your liquidity need, your liquidity buffers, and then finally, how do you meet those objectives of security, liquidity, and yield, and some of the tools that people are using to do that. So, a quick journey through the liquidity landscape. Where are we today? We'll touch on changing regulations, record levels of cash, very low interest rates, and the general attitude to risk and risk aversion. So, that very famous cash mountain, corporate city on record levels of cash. The chart we're showing here is the S&P 1200. We've stripped out the financial institutions from that list, so it's about 1,000 of the largest listed corporates around the world. What we see here is cash levels have increased from just over $1 trillion equivalent 15 years ago to just over $3.5 trillion at the end of 2013, and that number's a little bit higher now. So we understand that in aggregate, corporate treasurers are managing the largest amount of cash they've ever had to in an environment that's changing very rapidly.
Nick, what's your feel for the ACT survey has a couple of things, but what's your feel for why this is? Because credit is so easy at the moment. Why is there so much cash?
I think a few reasons, Will. One's around, as you say, credit's so easily available that people are raising capital while they can. So we're at not just decade, but centuries low yield levels. So people are raising capital as they can. Activities of central banks, and we're about to see the ECB's next move, means there's a lot of cash in the system. And then there's that whole attitude to risk. People are not looking to spend their cash at the moment.
And do you think this changes the role of the treasurer? I mean, when I was a treasurer, I basically had to find money, and now it seems like everybody's placing money. Do you think there's a different emphasis on what we do?
I think there's a huge shift. Yes. So it's one of the reasons we've been focusing on liquidity, and I think it's another reason why it's a huge topic at the moment. And really, I've talked to a number of corporate treasurers who say really they now see themselves in the role of asset managers rather than liability managers. As we said, very low interest rates. So this chart shows 3-month sterling LIBOR, obviously the lower for longer story, and really no expectations imminently of any change in that. We could have shown any chart. We could have had euro rates here that have been even lower and negative at the short end. Swiss rates obviously fell again last week. So that challenge for corporates of managing record amounts of cash in an environment where it's really difficult to get a return on that cash. Risk aversion. What we're showing here is the S&P VIX index. Obviously, that's an equity market volatility index, but we're just looking at the overarching views to risk in the market. The spikes on this chart obviously reflect the key crisis points over the last 5 years. So the first left spike is obviously the Lehman collapse. Then we have in the middle the Portugal and Greece issues around 2010. The spike in 2011 is the US debt ceiling problems. And then the tick up in the last few months obviously reflects the collapse in oil prices and the recent shock on the Swiss franc. So there is volatility in the market, and there's a general attitude to risk aversion, concerns around macroeconomy, uncertainty. So we very much appreciate for the corporate treasurer managing an environment that companies and businesses generally are fairly risk averse, sitting on this pile of cash, but needing to be very careful in how you deploy it. And then the final piece of the liquidity, the landscape jigsaw, is the whole changing regulatory framework. So the banking regulations and other market regulations are changing the way banks manage liquidity, the market manages liquidity, and therefore corporate treasurers and corporates and businesses have to react, and the opportunities and challenges that creates for them. We've just highlighted 4 of the major bits of regulation which directly impact liquidity management. So top left we have leverage ratio, which is the recently introduced new capital ratio for banks. So obviously we already have the equity tier 1 against risk capital. We now have this simple leverage ratio, which is capital against absolute size of the balance sheet. And that really impacts liquidity because it's a constraining factor on the scale of banks' balance sheets and therefore the availability of capacity to take deposits, the capacity of the repo market, etc. We then have 2 on the right-hand side, 2 regulations which directly impact bank liquidity management and have a direct impact on corporates. Liquidity coverage ratio, which I'll go into more detail in a second, that's the short-term liquidity metric for banks. And then the net stable funding ratio is the longer-term metric. Net stable funding ratio, in very simple terms, as you know, is saying banks have to have more stable funding depending on the length and liquidity of their asset base. So longer-term assets will require longer-term funding, and that again directly impacts banks on the liability side and therefore their deposits.
Nick, before we move on, is there any particular times during the year where these are measured, therefore you're perhaps a bank is more sensitive to what it can offer to a corporate?
There certainly are period end dates of more sensitivity. I mean, we measure these all the time, so we have to remain within those metrics all the time, and we would report that internally daily. But certainly, banks and businesses, as you know, will look at quarter ends and particularly at reporting date ends, year end, etc., in terms of exactly what metrics and where they want to be. So often we'll want to exceed certain regulatory metrics, for example. So as I said, we spend a little bit more time on the liquidity coverage ratio because that really directly impacts short end of bank balance sheets and therefore what banks do with shorter end deposits and the impact for corporates looking to place money. What we have here, and my apologies, it's a fairly busy slide, but we are showing how the liquidity coverage ratio is calculated and the main inputs and therefore why it knocks through to corporates. So the liquidity coverage ratio is the bank's key short-end liquidity measurement. And what it's looking to do is ensure that banks have sufficient liquidity buffers to meet unforeseen stress scenarios. And this is liquidity coverage ratio, the LCR is measured over a 1-month period. So banks need to calculate the maximum outflow of cash over a stressed 1-month scenario and need to hold a liquidity buffer against that. And that liquidity buffer needs to be held in high-quality liquid assets, government bonds, cash at the central bank, etc.
In fact, Nick, isn't that where most of corporate deposits actually tend to be? Because I think from the statistics I know, there's this huge lump of cash which is invested overnight. So actually, this is an important thing, isn't it?
Absolutely. Well, you're completely right. Most deposits tend to be fairly short, and a lot of them are sub 1 month, and they're front center impacted by this. So what we have here down the left-hand side is, and the regulation requires banks to categorize liabilities, i.e. deposits, by the type of entity making that deposit, and it splits across individual retail deposits, SMEs, and that's a regulatory definition of SMEs, other corporates, so you in the audience are in that dark blue corporate bucket, and then financial institutions. The next column towards the right is outflow factors for deposits and any other unsecured wholesale funding. So those numbers there are the percentage that the bank has to assume will flow out or not be rolled over and renewed during that stress scenario. So at the bottom you can see sub 1 month deposits from financial institutions are assumed 100% will not be rolled over, i.e. 100% will flow out. For corporates, in aggregate, 40% is assumed to flow out. So you can immediately see from a bank's perspective, corporate deposits are significantly more attractive than financial institution deposits because 60% of the corporate deposit can be used for funding the term balance sheet. Only 40% has to go to the liquidity buffer. And then obviously SMEs and retail deposits are even more attractive.
There's a big difference then, Nick, between the two columns, the 40% and the 25%. And so clearly there's an attraction for a corporate to prove that this is an operational deposit as opposed to let's say a term deposit. And first of all, what difference does this make in yield? And also, what do you have to do to be able to prove this is an operational deposit?
The yield will depend sort of situation to situation, and I'm not going to quote you a price right now. But there will be, and particularly on very short ends of overnight deposits versus instant access operational account, there'll be a significant pickup on the operational account. To prove it, it really needs to be an operational account. So it needs to be a transactional account with payments being made in and out, used for funding the business.
Would it be worth a corporate opening lots of cash management banks and say, therefore, I've got lots of operational deposits to improve my yield?
It has to be used for operational purposes. So if you have sufficient payments and disbursements being made, and you can support lots of accounts, you could do that. From the bank's perspective, we need to see that it is an operational account. We need to see movements in and out. And that's obviously something that the regulator is, in fact, at the moment, still finalising the regime around that. So liquidity coverage ratios, say, LCR, absolutely key in terms of impact on the deposit market.
Actually, Nick, if I can just stop you again. We've had one question asking to define the difference between the first two columns again. If you perhaps just spend another few seconds just covering that.
Sure. So the first column, deposits and unsecured wholesale funding. Those are, from a corporate perspective, those are your investment accounts. So contractual term deposits or investment accounts you're holding where you're not using it to fund day-to-day business activities, so we wouldn't be seeing payments in and out regularly. Operational deposits are your transactional accounts, so those are the accounts where you'd be paying the wages from, paying bills, having supplier payments in, etc. And there's that little red circle showing that key difference between operational accounts and investment accounts. I'd like to turn now to an overview of that regulatory reform agenda and how it knocks through to corporates. And we've obviously touched on some of the impacts. So the bank capital and liquidity regulations in total, they are and will result overall in a reduction to the credit creation capacity of the system overall. We've already seen that. Obviously, aggregate bank balance sheets within Europe have shrunk, for example, by about 2 trillion euros equivalent, and we would expect further shrinkage as capital ratio requirements continue to rise, leverage ratio requirements come in, and banks have to hit higher targets around that. Cost of credit will ultimately go up, all other things being equal. Obviously, the moves by central banks, quantitative easing, LTROs, etc., means that the effect of that's currently being masked. There'll be a steepening up of the pricing curve, again masked by the fact that interest rates have been so low for so long. But as I'm going to say, when they normalise, I'm not quite sure what normal is anymore in interest rate terms, but when they go back to where they used to be, then one would expect a significantly steeper curve, particularly at the short end. And obviously banks are now managing across multiple metrics. So whereas historically banks have looked predominantly at return on capital, we're now looking at return on capital, also return on absolute balance sheet capacity and return on liquidity capacity. The next bucket of regulations around bank structures. We don't really have time to dwell on that today, but this really has an impact on corporates that, as measures such as ring fencing come in, that's not due for a number of years in the UK. We're looking at 2019. The proposals in Europe are Liquidity, Volcker rule in the US, etc. What it's really doing is making, from a corporate perspective, the landscape more complicated.
Do you think corporates are at the bottom of the queue? Because we hear they talk about the bail-in, and who's behind corporate term deposits?
There is a much larger stack of equity in the banking system now. So much more tier 1 equity and a lot of bail-inable securities that are below unsecured wholesale depositors in the waterfall. So for most banks, we're looking at low to mid 20s in total capital and bail-inable before you get into any unsecured. Then, of course, there are our old favourite market regulations, Dodd-Frank, EMIR, forthcoming MiFID II, etc. In summary, the impact for corporates there will be as for those corporates already active or corporates looking to be active in securities markets, etc., for liquidity purposes. So if you're buying corporate bonds, CP, etc., repos, The impact of those regulations is, again, greater complexity, whether it's reporting, whether it's the type of venues you have to execute on, and then also a split in terms of liquidity pools driven by thefts and different local regulatory requirements. And then the final bucket are those other regulations, such as the money market fund reforms, and the fact that a lot of regulations, while the same in principle across the G20, are implemented, as we all know, down at a local level. The details are different. Again, further makes the corporate's job harder and the Treasurer's job particularly harder. And we certainly hope that your boards are cognizant of how much harder and more complicated your job has become.
We have one specific question actually asking, because you mentioned here about different US and EU regimes, about the ratios of 40 and 25%. Is that the same across in the US as it is in Europe?
On the LCR. It's similar, so again, similar in principle, but how you actually determine what's an operational account, etc. It will be a different regime around understanding that. So we've taken a journey through the landscape and the background, obviously now honing in on the liquidity objectives, so the very familiar security, liquidity, yield, or as Will tells me we should call it SLI.
Yes, and we teach our treasurers make sure that security, liquidity and yield are managed in that order. And it always strikes me as odd, well, if that's the case, why don't we just buy government paper?
I think if it was only security, that would be a reasonable response. The fact in many markets, particularly short end of markets, government paper is now negative. So it's arguable whether you've got security when your capital is eroding in negative yields. And I think it is a balance between security. Again, you probably don't want all your eggs in one basket. So diversified portfolio. You do need that liquidity. Again, a diversified portfolio means it's not just the tenor of the instrument, but also different markets, liquidity changes. And then yield, it's third, but it is still important. So in order to meet those goals and those objectives, obviously corporates all have well-entrenched treasury policies, and part of that will be the investment policies. So what we've done here is just simplified in terms of the 5 key components that we would expect to see within a corporate investment policy, or in fact any investment policy. So starting on the left-hand side, counterparty risk. So that's predominantly the security question. Are you investing with entities where you can expect to get your money back? And the policies around how much risk you're prepared to take on that credit. The next is market risk. Obviously within your investments you can take interest rate risk, foreign exchange risk, etc. So you need a policy around whether you can take any and to what extent you're able to take it. The third area is liquidity, and we're obviously using liquidity in a number of different ways in this presentation, but liquidity in terms of access to your investments. So what tenors are you prepared to invest to? That's obviously driven by your anticipated need for cash and over what time horizon. And we'll come on to that a second when we look at the liquidity buffers. But that needs to be an important component of the policy. Operational risk, you need to make sure that your policy covers ways to prevent just ordinary human error, mistakes. You need policies against fraud. You need to make sure that while the landscape becomes more complicated, that the processes don't become so complicated that you're setting up a too fragile system. And talking about systems, obviously the policy needs to incorporate that you have the systems and processes and procedures to manage the different investments. And particularly if you're moving into new investments, that'll often require investment in new systems and new technology.
Can you give us some key messages perhaps on creating a good investment policy. I mean, treasurers definitely need an investment policy for their own protection, because it's far better to go to the board saying, well, I only got 20 basis points as opposed to 30 basis points, but at least I kept hold of the money. I didn't lose it. So some key messages and perhaps some good ones and some poor ones that you may have seen out there.
I think one message would be, as we said earlier, with many corporate treasurers becoming more like asset managers, my advice would be lean on your banks. You ask your banks for as much as you want to get. Banks have their own internal liquidity management policies, which they can run through as a guide. They're obviously dealing with asset managers, so it's seeing investment policies from that perspective. People that are the kind of day job is meant to be investment. And then in terms of make sure that your policies cover all those key areas, but make sure you've got the flexibility that as markets change, regulations change, that you're able to adapt to that.
I bet you've seen some real howlers out there, have you?
Well, a few, yes. We'll talk afterwards.
Okay.
We'll just touch a bit more depth on the counterparty side, because as we keep reinforcing, it's security that is the most important objective from a corporate treasurer's perspective. So looking at counterparty credit risk factors, you really have two main measures here. There are the objective and backward-looking measures, which will come through credit ratings or direct credit analysis, etc. And then you'll also need to be cognizant, apologies for the police car running behind us, you'll need to be cognizant and keep an eye on news flow. So if something changes, some event happens to the counterparty you're investing in, you need to know about that. The quantitative factors around that, so if you're looking at a counterparty, what would be the main factors you want to consider? And I know for many of you this is absolutely apple pie and cream, but you need to understand the capital position of the entity you're investing with. So is it well capitalized? Does it have the strength to survive stress scenarios? Looking at the share performance is often a good guide. The stock market will often be a lead indicator of any problems with a business you're invested with. Liquidity. Does the counterparty you're investing with have sufficient liquidity itself to make sure that when you need liquidity, it has it available for you? And that goes back when I said earlier that banks are now managing across multiple metrics, and we're looking at how much liquidity capacity we're providing to our clients. And you need to be cognizant of how much liquidity capacity your bank and any other counterparty is providing to you. Obviously, all the balance sheet strength factors, and then the funding position. What's the funding position of the counterparty that you're dealing with?
These questions, to try and research these questions of a particular bank is actually quite demanding. I mean, I've certainly never asked these questions of a bank when it walks through the door. How do you suggest a treasurer actually goes about this?
The credit rating agencies will have looked at all these factors. So looking at credit ratings would be a start point. But you're right. It's depending on the quality of the banks you're dealing with, the jurisdictions they're in, will probably impact how much of this information you really want to dig into. But again, your close relationships with your banks, you need to feel comfortable asking those questions, and you should get the answers to them.
Would it be worth you perhaps setting up a briefing sheet? The banker comes along to the treasurer and says, look, there you are, here we are, this is where we are on capital buffer, this is where we are on liquidity, and so on and so forth.
It's something we do. We have that information, so if people ask us first, we have that available, and it's what we would provide to our investors as well on the equity or bond side.
Yeah. I think one thing I would possibly add in there, perhaps it's in use, so is the CDS.
Yes.
Price.
Yeah, no, very good point, Will. And then there are qualitative factors, again, that you want to look into. What's the management strength of the business? How open is the counterparty? That really goes to Will's earlier point. Your counterparty should be happy to answer all these questions when you ask them, how responsive they are, and then what's your overall relationship strength with that counterparty. So we've talked about the landscape you're operating in. We've talked about the objectives and policy setting. Just quickly, we need to touch on how much, when you're managing liquidity, how much liquidity do you need? And then finally, we'll touch on how do you manage that liquidity. So this is a very stylized representation, this graph, and what we're showing is in terms of trying to size how much liquidity you need, so what we would call the liquidity buffer. What this is showing is cash requirement and probability for that requirement. So in the middle, the lighter green hump in the middle of the distribution is really, that's your regular cash requirement. So all anticipated dividend payments, your net cash flow, predicted capex, etc., etc. That'll be in your day-to-day planning. The hard bit is trying to size the bits at the tail of the distribution, and that's always the way with trying to size unexpected requirements. And really the main purpose of this chart is to show on the left-hand side, surprise events on the left-hand side are fine. If you end up with lots more cash than you ever expected, something very nice will have happened. But on the other side, unexpected requirements for significant amounts of cash outside of your normal expectations. And we've got a hump there because it always tends to be the case that those come along more frequently than expected. So we can all think of the black swan events that have passed over the last 10 or 20 years, whether it's corporate, bank, or whatever.
Well, I think it's worth Treasurers doing stress tests on their own situations to see what might happen. And of course, you never know when the Chief Executive is going to come down the corridor and say, right, we need all this cash and more.
Yes, absolutely. And that's something we spend a lot of time with our corporate clients looking at trying to model that.
Yeah. But whatever this graph sort of seems to say about how far you can term it out, it all seems to come back to overnight almost.
I think while this graph shows you might have a need for a lot of cash, when you actually drill into scenario analysis around disasters or even if it's on the positive side, as you say, Chief Executive comes out in the corridor and says, I'm about to do a big M&A deal, the reality is you're usually not paying the bill tomorrow morning. You're usually actually paying the bill in 1 month or 2 months or even spread out over a number of months or years. So while you need to have sight of access to cash, and it could be cash on the balance sheet, cash equivalents, it could be undrawn committed facilities, I think there is a tendency within the industry to think that's needed more quickly than it really will be. So in order to determine that liquidity buffer requirement, you'll need to do the strategic planning. So look at your historic cash flow volatility. Where are your available liquidity resources? As we mentioned, is it your cash equivalents on the balance sheet, or is it committed facilities you have available, or just expectations of, depending on market conditions, your availability to borrow at the time? That needs to be modeled and factored in. Take your view of your future cash flows, obviously key, and then working through what's your flexibility in your business levers. So you may have a predicted cash flow requirement, but you may be comfortable that you have the ability to flex your cash requirements. So it could be if you have a flexible dividend policy, it could be your ability to reduce capex, etc. As we said earlier, liquidity management is becoming more complex. What we're looking here is Company A on the left-hand side, and we haven't brought up Company B, but Company A operating with what we call a traditional liquidity management strategy. So committed facilities, operational cash, term deposits, and perhaps investments in money market funds. With the scale of cash required, with the scale of cash on balance sheet now, and the challenges in the liquidity environment of very low yields, more and more corporates are now looking to branch out into a broader range of investment products to cover that liquidity management. So it could be repos, it could be direct investment in securities, CP, government bonds, corporate bonds, etc. This is the move from traditional corporate liquidity management, the changing buying behavior as you move towards becoming a surrogate asset manager.
Can we just think a little bit more about some of these products? I don't think you've got any numbers on the screen here, but how big do you have to be before you can think it's really worth spending the money to go into repos or CP or government bonds?
It will partly depend on the infrastructure and systems you have in place. So if you need to re-engineer your treasury systems to accept securities, for example, or if you need to put in place custody arrangements in order to do repos, then you need to be doing a reasonable amount and on a regular basis for it to be worthwhile to make that investment. But any corporate running low hundreds of millions equivalent, if you're going to spread it out across some of these investments, that would justify subject to your existing infrastructure. But you're right, it's not worth doing it for very small amounts of cash.
Yeah. Give us a number, Nick.
I know you're pressing me for that. I'm really going to duck that.
Yeah.
But if I was going to, and nobody held me to that, but 10 to 20 million per product. Before below that, it's not worth doing.
Yeah. Okay. Can you tell us a bit about repos and corporate use of repos? We've had one or two questions about these. Are they growing, or is the complexity still putting some people off? And how easy is it to get into them?
It's certainly growing. It's certainly very significantly growing in terms of numbers of corporates looking at it and actively working hard in terms of putting the infrastructure and the legal agreements in place. It's still relatively small from an absolute market perspective, but we would expect over the next 12 to 18 months to see a significant increase in corporate use of repo.
We've got one specific question which mentions that, in fact, he seems to be getting greater yields on secured repos than he does on unsecured deposits, and he finds it a bit perplexing, which I have to confess I agree with him.
Yes, and it's true. The demand-supply dynamics as the market and banking system overall adjusts to things like the leverage ratio and the net stable funding ratio. That's resulted in a significant contraction in market capacity. So you will find times where people have inventory that they need to place. They will pay a price that maybe looks surprising on a relative basis. But yes, it does happen.
And has the banking sector come up with any new products to deal with the liquidity ratio? So the 30-day timeline. What's out there in the market for treasurers?
Yes, the most popular and frequently used product would be the notice account product. So having accounts with 31, 32-day notice periods, that means the cash never slips into that sub 1 month bucket. That's the best simple way of addressing that.
Okay, and we've seen this in the retail market for some time, and sometimes you can go the notice period but forgive the yield. Is that sort of product available, or is that a bit more difficult?
That's really much more difficult because the regulation specifically looks at the outflow factor. So in the stress scenario, if you had given somebody the ability to take the money out early, you're really destroying the logic of the product.
But there's a price on anything, which, if for example, you give a notice account, is there the price that you will always say you'll come out of it and give the corporate their money back?
We would, and I would think most banks would never upfront guarantee that we would provide payback. It would really depend on the situation, and if there was guaranteed liquidity in that account, it would be treated as an instant access account and price. I'll quickly flip through as I'm conscious we're sort of 5 minutes from the end. What we've got here, and it partly addresses the earlier question, it's just a snapshot of yields running out to 12 months across a range of different products. So the dark green is an unsecured curve. We've just taken a Lloyd's unsecured curve, and then we have curves for UK government gilts, T-bills, gilt repo, that little red spot, which is money market funds, and A1 plus, P1 plus CP. People would certainly, I'm sure, question why the CP is the lowest curve here. That's a real supply-demand dynamic. The time the screenshot was taken, A1 plus, P1 plus CP is now very rare and very illiquid. Typically that would trade above governments, but just demand supply sometimes moves it around, rather like the repo market. So to wrap up, we've taken a quick journey through the overall liquidity landscape. What are the factors that are impacting on liquidity management, particularly on the regulatory impact, the requirement to have robust investment policies as part of your treasury policies, making sure that your strategy around liquidity is well thought through, that you've modeled up scenarios, you have a clear view on available sources of liquidity and potential uses, both expected and unexpected. Happy to take questions in the last couple of minutes.
Okay, we've had one specific question come here about the issue of bail-in, and I'm sorry, I didn't know this, but perhaps you'll confirm it for me. The inclusion of the UK in the fast track of the bail-in, along with Germany and Austria, could be beneficial for the UK in return of AAA ratings to banks. Do you see that, Nick? And perhaps this I could also combine that question with what's going to be the effect of the Vickers implementation of banks putting themselves up into safe and riskier banks.
So it's the first part of that question. Most banks are now, it's fairly long time since we saw lots of banks in the AAA category, and I think it may still be a bit of time till we get back to AAA, partly given there are very few sovereigns that are left at AAA, but certainly early adoption of prudential regulatory requirements move the dial quicker towards that. Specifically around ring fencing, obviously ring fencing you need to work through the impact of ring fencing with that resolution regime and the bail-in regime. So banks will have a holdco structure going forward once all the regulations in place, and the authorities will be looking for bail-in and resolution to occur up at that holdco level, and the operating companies, whether they're ring-fenced or not, the regulatory design is to make sure there's sufficient capital within the holding company that you never need to get into the operating company. And that was part of the presentation at the ACT regulatory breakfast that the PRA gave back in the autumn. So it is a complicated jigsaw, and I think what it means for investors in banks is you'll need to look both at the overall issuer rating at the holdco level and also the ratings of the operating companies that you're transacting or depositing with.
Okay, well, I think we've pretty much reached the end of our time. Unfortunately, we could go on and on. I'd like to thank everybody who's joined today's session. As I mentioned at the start of the webinar, we will be putting up a recording of this on our website along with the presentations in 2 days' time, and we will be sending you all the link to that. If you can spare a moment to provide some feedback on the webinar, we would be very grateful. Just select the feedback widget in red from the bottom bar. The facility to do this will remain open for a short while after the webinar ends. And I think I've just missed the slide, which reminds you about our forthcoming events. I particularly highlight the fact we have our cash management conference in a couple of weeks' time on the 11th and 12th of February, where this subject will be on a very wide-ranging and interesting agenda. And I'd finally like to thank Nick and Lloyds Bank very much for a fantastic contribution today on this important subject of liquidity management. Thank you again, and goodbye.